Yeah, welcome all of you around the world, especially here in Europe and also in China. We have now still morning in Europe, but already afternoon in China. I'm very happy to have you here in our second session of our China-Europe Finance Summit. The topic of our session is cross-border investments, especially from China to Europe, but of course also the other way around. My name is Horst Löschel. I'm a professor of economics here at Frankfurt School of Finance and Management and also co-chairman of the Sino-European Center, one of the organizers of this conference. Before I introduce my distinguished guests and panelists here in this session, let me introduce a little bit to the topic. Foreign direct investment, I already mentioned this. Of course, this is one of the most important financial as well as real flows, cross-border flows between China and Europe. To start with figures, last year China, for example, invested 12 billion euros to the EU. However, the peak year was 2015, and in 2015 it was already 37 billion euro, the foreign direct investment, the mergers and acquisitions and other investments of Chinese investors here in Europe. The stock of Chinese investments in Europe between 2000 and 2019 sums up to around 160 billion euros, which of course is already an amount, and we expect that this amount will increase in future as well. So far to figures, to quality, let's say, there's a lot of dynamic in this market, a lot of discussion and momentum. For example, China opening up more in recent years. One of the most prominent examples of this is the shortening of the so-called negative list, which is the list of areas and industries of business in China which are restricted for foreign investors. However, if this list has been shortened in recent time, that means there is more possibilities for EU investors in China. On the other side, in the EU launched the so-called screening procedure already last year that allows the EU Commission to issue concerns about some of the investments, which of course in a certain way makes the investment of Chinese investors here in Europe not more easy. Last but not least, there's already negotiations between the EU and China about this comprehensive agreement on investment. This is already ongoing for several years. Unfortunately, due to COVID-19, it could not be concluded as planned in the second half of this year under the presidency of Germany in the European Union, but has to postpone this discussion to next year due to the current situation. But I understand from the first negotiation round there is some optimism with all the politicians and of course also in business that there will be make progress and we get a reliable framework and contract between the EU and China about foreign direct investment. All these developments concentrate in some questions, and this will be actually the questions we are discussing here in our panel. One question, for example, is what are the reasons for the decline of Chinese foreign direct investment to the EU in recent years? Economic reason, political reason, business reason, we have to see this. And of course, looking in the future, will they pick up again in the future, which of course we are hoping very much from a European perspective. A second one is the Brexit. There is still no negotiation, but the Brexit is a fact in this or another way. And the question is there impact of this event here in Europe, important event, of Chinese overseas direct investments here in continental Europe. And last but not least, what are still the main attractive area for Chinese investors, for example, in technology, in healthcare, and chemistry? What are the preferred industry? This is more or less the framework. Having said that, let me now introduce my distinguished guests and experts here. We are very happy and thanks a lot that they join us here. Together with me in Frankfurt is Frank Klaas. Frank is the head of communication of Geely here in Europe and the US, and Frank has a very long track record in the area of communication for companies, for example, for Land Rover and Deutsche Börse. In Shanghai, I welcome my former colleague, Professor Chu Bin. Bin is a professor of economics and finance and associate dean research at the China-Europe International Business School. And he got his bachelor and master degree from the very well-known Fudan University in Shanghai and made his PhD at the Columbia University in the United States. So welcome, Bin. Thank you very much for joining us. Last but not least, we have in Beijing Mr. Niu, Frank in Beijing. Frank is a partner with Dentons in the office of Denton's office in Beijing. And Frank had actually also a very long track record, especially in the business of M&A and foreign direct investment, especially between China, Germany, and China, Europe. Frank had a Master of Laws of the Chinese University of Political Science and Law in Beijing in cooperation with the University of Florida College of Law in the United States. So welcome all of you. Thank you very much for joining us. Maybe let us know before we start with the introductory statement what will be that, let's say, the process, the schedule. We start with the introductory statement of the speakers. Actually, with Professor Chu makes the starting point. Then we continue with Mr. Niu, and last but not least, Mr. Klaas will give his statement. Then we have a first round of Q&A session. Myself will moderate this. Given your statements, I will raise some questions to you. And last but not least, of course, we have also a certain time for the audience. If you have any question, put this in the chat, and we will forward this to our panelists. Yeah, so far to the beginning. Thank you again for all of you joining us, and I hand over now for the introductory statement of Professor Chu in Shanghai. So, Bin, the floor is yours. Go ahead, please.
Ladies and gentlemen, I'm very happy to join this conference. So I'm going to give you some background about the Chinese economy. Okay. So China has entered the so-called reform and the opening era since 1978. So in the first 30 years of Chinese economic development, China relied a lot, mainly on investment and export. So China has high savings rate, so it has capital. It also attracts foreign capital. China has a young and abundant labor force. So combining capital and labor, China produces a lot. But China, on the one hand, is having high saving, on the other hand, is having lower consumption. Therefore, the Chinese economic model relies critically on the global market. So the global market was very favorable to the Chinese economy from the period of 1978 to 2007. Okay? And along the way, China joined the WTO in 2001, and China's economy boomed on the basis of globalization. However, the Chinese economy has changed. Since the global financial crisis, China no longer can grow, relying on the old engine of investment and exports. The global environment, even before the coronavirus, even before the Sino-US trade war, was getting unfavorable to China. So China faced a difficult challenge of transition from investment-based to consumption-based, from imitating technology exporting to innovation and domestic consumption. So that is a difficult process. And this process was interrupted by the Trump administration when it had these trade measures against China in 2008. But nobody expected that there's even more pressure for China after this 2018, which was what we are experiencing in this year. That's the global pandemic year. So what would that do to China? So in the short run, China recovered very well. Yesterday, the Chinese Statistical Bureau released the latest data on the Chinese economy. So China, for the first 3 quarters, achieved a positive growth rate of 1.8%, 0.7%. For the whole year, it's forecasted of about 1.8%. So China will become the only major economy in the world which would achieve positive growth this year. And that has a lot to do with the success of the Chinese government and the Chinese society to contain the spread of the COVID-19 virus. But I don't think we should focus too much on this so-called success in the short run. I think China, because of this pandemic, is going to face even more pressure, even a worsening economic environment for the middle and the long run. So I think the government of China was very clear about the situation. So about around like 2-3 months ago, the Chinese government proposed a new growth strategy, which is called double circulation. What is double circulation? One circulation is called internal circulation, relying on domestic demand. The other circulation is called external circulation, relying on the global market. But the government understands that now China, even without this pandemic, without the trade war, China would have to rely more on internal circulation. So the strategy was specified as mainly on internal circulation. But the internal circulation is difficult because it relies on the income increase and the lower tax and so on. So China is facing a difficult time looking forward. Let me just conclude by mentioning what this implies for this Sino-Europe investment relationship. I think China now, has to look to Europe more because US is no longer, a place that China would be able to look to in the future, no matter who became the US president. So I think this would really make Chinese government to issue policies in favor of European investors in particular, and in favor of a better Sino-US economic relation. So for this, I would conclude by saying that this is good news for the audience of today's conference. I'm going to stop here. Thank you very much.
Yeah, thank you very much, Professor Chu, for your encouraging words, especially very much at the end. Very favorable for cooperation between China and Europe. Thanks again. I hand over now, we move now from Shanghai to Beijing. And here we have Mr. Niu, Frank Niu. Again, he is partner from Dentons. So, Frank, the floor is yours. Please go ahead with your introductory statement.
Okay, thank you, Professor Lochel. It's a real pleasure to join the discussion here and share information and my thoughts from the legal side. Sorry. If we look at the situation from the legal development side, the situation inside China, where we see there's an improvement in the regulatory framework, meaning Chinese government has taken significant steps to reform the foreign investment regulatory system in the recent years. The reform is mainly evidenced by the new foreign investment law and its implementing regulations, both coming into effect on January 1st, 2020. The new system is based on the approach of so-called negative list, as you just mentioned, Professor Lochel, which is set out on a sector-by-sector basis foreign investment that are either prohibited or restricted. And any investment project outside the negative list are automatically permitted and do not require special regulatory approvals on case-by-case basis. Under the latest edition of the negative list, which took effect in July 2020, just a few months ago, a number of industry sectors were newly opened to foreign investors, in particular financial services and automobile manufacturing. And more industry sectors are scheduled to open to foreign investment in the coming years. This is a fundamental change as we see it, as a move in the right direction to increase the market access and level the playing field of foreign investors in China. Moreover, the new regulatory framework includes streamlined and simplified regulatory procedures, including what we call a post-investment information reporting system that has replaced the previous regulatory approvals of filings. This has increased the transparency and made it more convenient for international companies to do business in China. So this is the development on the China inbound side. And then if we turn our situation of outbound investment from China, as people have noted, we see a continued decline in the overall volume and the number of transactions, investor transactions made by Chinese companies in recent years, including the transactions investment made in Europe. The total volume of investment fell roughly 30% in 2019 and a further 5% in the first 9 months of 2020, according to the statistics released by the China's Ministry of Commerce recently. There could be a number of reasons for such a decline of China outbound transactions. On the legal side, the Chinese government maintains a relatively strict regulatory and policy control of overseas investment by Chinese companies in recent years. For example, Chinese companies are usually not allowed to invest outside their main business areas. And the investment in certain what is called the sensitive industry sectors, such as real estate, entertainment, and hotels, are restricted and require special approvals. With that said, I know that Chinese investor interest and appetite in overseas investments, including in Europe, remain very strong. One evidence is that the Chinese investment in Europe still exceeded $13 billion in 2019, and this represents a relatively less decline compared with some other markets, such as North America. My understanding is that once the short-term factors impeding outbound investment disappear, more investors will be back to the market in deal making. And we are reasonably optimistic about the future development in this area. But in the short term, we do see difficulties from the investor perspective. And in addition to the situation in China, Chinese investors face legal challenges on the EU side, especially EU's new FDI screening framework, which just took effect, I think, earlier this month. My view is that I completely understand the policy concerns and the motivations of this EU legislation, which is nothing but a national security review process, which is already part of the FDI regulatory system in China and other jurisdictions, such as the CFIUS review process in the United States. But on the other hand, many Chinese companies in particular the state-owned enterprises or SOEs, see this development in Europe as a risk factor, meaning more uncertainties and higher costs in completing investment transactions. From the investor standpoint, I believe it would be helpful if the EU regulators and the member states provide more guidance in the implementation and enforcement of this new FDI screening framework and FDI review process. For example, the key concepts such as the threats to national security and public order or EU interest and the foreign government control of the investor should be clearly defined or as clearly as possible. And the safe harbors or list of companies excluded from FDI can be published by member states. I mean, this is a concept similar to what we have as a negative list, basically telling the investors which can and cannot be invested. And the review procedure should be as much efficient and transparent as possible, potentially including fast-track procedures for transactions that on its face do not appear harmful to the national security of a member state. These efforts should help reduce the relevant transaction costs and uncertainties to investors. In this connection, I believe the ongoing discussions of the comprehensive agreement on investment between China and the EU should be helpful and have positive impact. I think the government on both sides can work together to address the challenges and solve the issues faced by private investors. If the EU regulators in the member states, for example, need more information about a specific Chinese investor, and there can be an information exchanging and a verification mechanism put in place at the government level, just like the current collaborations between the financial industry regulators in China and other countries, including some EU countries. I mean, this is the mechanism we see that really work well in practice. On the other hand, the EU regulators and member states need to be more transparent in their review and the communications with Chinese investors to let them understand what the concern is and how the concern can be addressed in the transactions. Another positive step that can be taken on the EU side is to have not only a uniform FDI screening framework, but also a unified FDI review process. As we know, the FDI screening framework is only intended to coordinate the actual review process at the member state level. There could be more than one FDI review process in a specific transaction, especially multi-jurisdiction investment transactions involving more than one jurisdiction. So if the EU can have a common FDI review process, such as already you have for the competition or merger control review at the EU level, I think that could be a significant improvement of the efficiency for the investors. So these are some of the comments I want to share and with our audience here and see if you have any questions. But I'm glad to answer any question from the legal side.
Mm-hmm. Yeah, thank you very much, Frank Niu, for your very comprehensive overview about the legal situation. And as you already pointed out, it's somehow complicated, the development, but also very dynamic. We will come back to this later in the discussion, of course. And I'll now hand over to Mr. Klaas, Frank Klaas. Frank we are now back here in Europe, in Germany. Frank is Vice President and Head of Communication of Gailey Europe. So, Frank, the floor is yours. Please go ahead.
Thank you very much, Professor Löchel, and also a very warm welcome from my side. And thank you very much to the team of SINEX to invite Geely. Coming from just another industry, I think it's great for us to present ourselves here. So thank you for this marvelous idea. To start my little presentation, I just wanted to remind you what we are reading in the current situation about the automotive industry. It's an industry in crisis, an industry in transformation. A lot of German newspapers are reporting in a daily way about job losses, for example, for the big suppliers and. And the reason is not only the crisis of COVID-19, it is an industry in transformation. And therefore, I'm very happy to give you some thoughts about Geely and how we are managing this very challenging situation of not only the European, but for the global automotive industry. And Mr. Chu said rightly that one key word plays a key role if we want to communicate in today's industry and if we want to solve problems. It's the word global. Geely has a philosophy to become and to be a global manufacturer and a global brand. And it is the founder, Mr. Li Shufu, who founded Geely in 1986, who gives a clear direction that in the future the automotive industry of the world can only survive if she's working together globally, means bringing all the experts of different countries together. Geely was founded, as I said, in 1986. In 1997, it was a clear direction to establish Geely Auto. And in the big economical crisis, in the financial crisis in 2009, Geely was so successful to buy Volvo from the Ford brand. And this is an example which is, I think, a very good example to explain what Geely is standing for. I was working for American companies like General Motors, but also Ford. And the way Geely was able to manage the situation in Sweden is completely different in comparison to what the American companies like General Motors or Ford did with their brand. Saab, as a daughter of GM, is not existing more. And Ford was not quite successful managing the Volvo team. Now Volvo is a key player in the automotive industry with daughters like Lynk & Co., I come later to this brand, and for example the full electric brand Polestar. How was this possible? What I could see, and this is not because I'm working for a Chinese company, the approach to be global is a complete other one than in comparison, for example, to the Americans. The Chinese culture is coming to other countries and to other brands, for example, with a big respect, respecting the values, respecting the knowledge, but also emphasizing the culture of the working people. And this was one of the reasons Volvo is now one of the successful premium brands, not only in Europe, but also globally. Geely is coming to Germany too. And we have established in last year, in 2019, an engineering center exactly here in the region of Frankfurt. So why coming to Germany, to a high-price country where people are probably paid much better than in other countries? Well, Frank Sinatra had a song which is very famous, New York, New York, you remember, and he had a good saying. If you make it there, you make it anywhere. And this is exactly the point what Geely is thinking about developing different markets and philosophies. To be in Germany means to be there where the premium brands like Audi, BMW, and Mercedes are established, and BMW too. So this means that we have here the expertise of excellent people to develop the mobility of the future. And to invest here in Germany is the right step for Geely to understand what this market means. And therefore, we have established here, next to the Frankfurt airport, a development center called GATD, Geely Auto Technical Deutschland. We are creating jobs here in a crisis situation where other companies are reducing jobs. We are hiring experts of the industry. We want to be in the market where the premium technology has been developed, and we want to be strong here to understand better what this market is going to. And this is part of the philosophy of Geely, Geely has bought different European brands and supported them, like, for example, a brand called London Taxi. You know, these black cabs, very famous in London, with diesel engines and normally not the best cars regarding pollution. Now, the London taxis are running with electric engines. It's an electric taxi managed by Geely, and the company, with a completely new factory in Coventry, is producing these with much modern technology. And it's a quite astonishing success in London. We have sold now, in a short time, at about 5,000 electric cabs, and they are using partly parts and technology from Volvo, and they are sharing it. So this cab is coming also to Germany, it's coming to other European countries, and we are also, because of, we talk about the Amazonization of the market, so the delivery culture is growing, therefore we are also building out of this little delivery van, which is running electrically. This is an example, and a journalist, a friend of mine in London, said very clearly, what is Geely standing for? And he said, yeah, seems so. They are taking a piece of carbon and polishing it in such a long way that they have a diamond at the end. And this is probably a way of Chinese culture investing in these industries. It's not what I have seen, and I have a lot of friends still in General Motors and Ford, and it's not criticism against the American culture, but this was very short-term thinking. And where is the American automotive industry today regarding globalization? Geely is going the other way and has a long-term vision and has a long-term plan. So investing in a difficult situation in a company which was nearly bankrupt, like London Taxi, and making out of this kind of like an environmentally friendly car, and using the brand, which is famous, the London Taxi, makes a lot of sense. And we see this in other cases too. For example, Lotus was in a very difficult situation. Now Lotus is going into the headlines and producing the most powerful full electric sports car in the world. This means Geely's philosophy is not like, for example, the Japanese philosophy in the 1950s and 60s, coming with own brands to be established globally. Geely is using the technology and the brain of their engineers globally, but also taking brands which are probably in a difficult situation to another level. On the other side, being partners, and this is very important for Germany, Geely is connected to Daimler. As you know, we are owning 9.67% of the Daimler shares. We are partnering, and being global means for Geely, for example, that we are solving one of the biggest Daimler problems in the past, means the future of the smart. Now, Smart is a joint venture between Geely and Daimler, and the cars will be designed here in the Smart team, but produced in China in Geely factories, and therefore you can have a smaller car, but make it also profitable because of the Chinese production. So everything we are doing is a long-term strategy. And I'm very glad to present this philosophy, and I could talk of, you can believe, for hours. But I just wanted to explain to you a little bit in one sentence what our philosophy is regarding communication, because there is also a big difference between, for example, the American way of communicating regarding companies' values and the Chinese one, what I have expected. Geely is communicating results, and when we have achieved something, and other companies and, for example, other cultures are communicating their plans. What I learned was a little bit to learn and to communicate like the result or like the story of the tiger, who is the best hunter in the jungle. But nobody sees him, but he's strong and powerful, but everybody sees his results. And this is a little bit the philosophy of how we are communicating to be global.